Welcome to this video tutorial on Chapter 15, Salary versus Dividend. Now, the question of whether an owner-manager of a CCPC should pay themselves a salary versus a dividend is very common in practice. So this question and solution will go through the calculations from a tax perspective to determine from tax costs which one would be beneficial. Moving on to the next slide, this is the question. If you have not yet read the question, pause the video now and read through this question before moving on. As you notice in the question, this is based on the 2019 taxation year. And if you are watching this video and you're using tax rates that are other than 2019, just be cautioned that this is based on the 2019 dividend tax credit and gross up rates. Let's move on to the next slide and look at the case requirements. Now, also, if you have not yet worked through the answer and read the case requirements, pause the video here. There are 3 requirements. The first bullet point, what is the amount of salary that Nick would require from C Corporation to have after-tax funds of $50,000? The second one is what is the amount of the dividend? Now, with the dividend question, you're going to be doing some interim calculations. Round those interim calculations to 4 decimal places and use that to work through that part 2. And then the final question is based on your calculations, which is going to be the better alternative that has the lower overall tax cost to C Corporation and Nick. So pause the video now, work through the question, and then resume the video for the solution. Okay, let's move on to the next slide and look at the first part of the solution. The first part asks, what is the tax cost, what is the required salary and the tax cost if C Corporation was to pay Nick a salary? Now remember, Nick requires $50,000 of after-tax funds. So we're just going to set this up using simple mathematics. X is the amount that he requires of before tax salary minus times 1 minus 0.53. 0.53 is Nick's personal combined tax rate, and that needs to equal 50,000. If we rearrange the calculation, X is going to be equal to 50,000 divided by 0.47, and working through the math, we see that Nick will require that C Corporation pay him a salary of $106,383 to be left with $50,000 of after-tax funds. Fairly straightforward. Now, what's going to be the overall tax cost of this salary alternative? Well, first of all, he's going to have to pay tax. Nick's personal tax is going to be $56,383, which makes sense. If he gets paid a salary of $106,383 minus the personal taxes, provincial and federal, of $56,383, he will be left with his $50,000 of after-tax funds. Now, the other thing to note is that when C Corporation pays Nick the salary, that's going to reduce C Corporation's taxable income. So there's going to be some tax savings. Working through the math, the dollar amount of the tax savings to C Corporation, $13,830. So the net tax cost of the salary alternative is $42,553. Once again, a fairly straightforward calculation. Let's move on to the next slide and let's look at the dividend required. Now, with the dividend required, this is a little bit more complex. What I always tell the students to do is step number 1, figure out what is the tax rate for Nick if he was to get $1 of non-eligible dividend. Now, we know that C Corporation, if they pay Nick a dividend, it's going to be a non-eligible dividend because in the question it said that C Corporation had 0 amount in their grip. And so therefore, all the dividends would be paid out of LRIP, the low rate income pool, making those dividends non-eligible. So if Nick was to receive $1 of non-eligible dividend, he would include that $1 in his income. Now remember, dividends must be grossed up. As of 2019, non-eligible dividends are grossed up at 15%. So $1 plus 15 cents his taxable income would be $1.15. Now, he's going to pay tax at a rate of 53%, so he's going to pay tax of 60.95 cents for every dollar of non-eligible dividend received. However, he's also going to get a dividend tax credit. Now, the dividend tax credit, there's a federal component and a provincial component. The federal component is 9/13 of the gross up. In the question, you're told that the provincial dividend tax credit is 29% of the gross up. So 9/13 plus 0.29, multiply that by the 15-cent gross up. His dividend tax credit for every dollar of non-eligible dividend is going to be 14.73 cents. And so the net amount of tax for every dollar of non-eligible dividend will be 46.22 cents. Now, what you can do is, once you have an understanding of how we get that 46.22 cents for every dollar of non-eligible dividend received, you can rearrange the formula to look like this. And once again, if you want to pause the video here, pause the video, see how this last bullet point basically summarizes that entire calculation that we did above, and we would get the same 46.22 cents for every dollar of non-eligible dividend received. So that would be his tax rate. Now let's move on to the next slide and look at the next step. Once we've determined that, then we can figure out how much dividend would Nick have to receive. So once again, simple math. X is the amount of pre-tax dividend. 1 minus 0.4622. Remember, we said that for every dollar of non-eligible dividend that Nick is going to receive, he's going to have to pay 46.22%. And so the after-tax amount needs to be $50,000. We rearrange the formula and we calculate that Nick will require a dividend of $92,971 in order to have after-tax funds of $50,000. Now, let's actually prove if this is correct. So let's actually go through the math. The non-eligible dividend, $92,971, that needs to be grossed up by 15%, and so the taxable dividend, $106,917. Now, he's going to pay tax at 53%, and so the tax before the dividend tax credit, $56,666. Now, the dividend tax credit, 9/13 federal, 29% provincial, add those two together, multiply by the gross up, the $13,946, that's going to give him a dividend tax credit of $13,699. So the personal tax payable is going to be $42,967. Now, also remember that there's no corporate tax savings if C Corporation pays a dividend, because remember, dividends are always paid after tax. So the overall calculation, we're going to see that he's going to get a $92,971 dividend, pay tax of $42,967, and that's going to leave him with the $50,000 after-tax funds. Now, we're going to get $50,004, but that's just because of the rounding we did up above, only to 4 decimal places when we figured out the tax rate. Okay, let's then go to the next slide and look at the final requirement. What's the best alternative for Nick and C Corporation? Well, it's pretty straightforward. We see that the dividend alternative has a higher tax cost. The dividend alternative had a tax cost of $42,967, whereas the salary had a tax cost of $42,553. So the dividend alternative is going to result in more tax overall. So therefore, the salary alternative would have the lower tax cost. Now, in this question, we know that Nick has already received a salary of $215,000 from C Corporation. So other issues such as CPP, the Canada Employment Tax Credit, those are not relevant to our analysis here. Just as a final word, this solution and question is based on the 2019 rates for the dividend tax credit and the gross up. So if you are using a different taxation year, you can still work through the calculation on your own, but use the new dividend tax credit and gross up amount for the year that you are currently in. That brings us to the end of this video solution, and we'll see you in the next video.